All right. Good evening, class, and welcome to our taxation class today. Okay. Sorry you will not be able to see my face right now because I'm in a place where there is no light, and I am grateful that you can see my notes. Okay. So since you can see my notes, um, that's all that matters. Today we'll be taking a look at taxation of specialized businesses. Okay, all along we've been talking about business income. We've been talking about sole proprietorship. We talked about companies. Now we are looking at what we call a specialized business. Okay, after you study this topic, you should be able to understand the peculiar laws relating to specialized businesses and how to compute the tax payable by special businesses, including minimum tax. Okay, so now let's look at tax provisions for real estate, agriculture, and so on. If you look at a real estate, these are people who are into property. The taxes that are applicable to real property transactions in Nigeria are as follows. There's company income tax, which is normally payable at the company income tax rates. Then we also have the personal income tax that are aimed or chargeable to people who are under the PITA regime. For companies, the corporate rate is 30% of the total profit, while for individuals, registered business enterprise or partnership. Okay, so if you are into partnership or you are into business name, not limited company, you pay between 7% down to 24%, depending on the level of your income. We know all this graduated rate now. Fine. Then we move to withholding taxes. Withholding taxes for real estate. The payer of any income is expected to withhold 10% or 5% with respect to the recipient. If the recipient is a company, it's 10%. If it is a partner, if it's an individual, it is 5%. Okay? It should be noted that the taxpayer is entitled to deduct this tax in advance so that the final tax liability is discharged when the withholding tax credit note has been applied. Okay. In cases of dividends, withholding tax dividend is the final tax in the hands of the recipient. Then we talk about the tertiary education tax. Like any other taxable person, companies that are into real estate are expected to pay the tertiary education tax in addition to the company income tax. So whenever any company is paying company income tax, they always pay education tax. But if it is a person who is into the personal income tax regime, you don't need to pay the tertiary education tax. It's only those who are companies. Then the value added taxes are involving any transactions that are vatable, any transaction that requires vatable items, and any company involved in real estate are required to register for VAT within 6 months of commencement of business with the relevant tax authority. Okay, and so all the goods that are invoiced are to be invoiced with the VAT rate. So that means you are going to be given what they call a VAT receipt. What is a VAT receipt? A VAT receipt is a VAT invoice, rather, is an invoice that shows your VAT. So that means you calculate the price of the goods without VAT, get a subtotal, then you calculate the VAT and add it to the subtotal to get total VATable price. Okay, so here the VAT here is 5%. For the purpose of your exams, for this diet, VAT is 5%. But you know that in Nigeria, VAT has since risen to 7.5%. Okay, personal income tax. The personal income tax comes into play when you sell a property or when you receive rent from rental properties you own. There are earnings based, these are earnings based on which you are expected to pay your taxes. Okay, in Lagos State, the percentage of this tax starts from 5% all the way to the flat rate of 20% for those who earn as much as 1 million naira per month. So this is the kind of tax that they pay when you receive rental properties. Then we also have the Land Use Charge Act. The Land Use Charge is like a ground rent that is paid annually by property owners in Lagos, Nigeria. So this is peculiar to Lagos. If you are a property owner, you pay your land use charge. It's more like a ground rent or like a tenement rate paid to the government for granting the request to lease the land. So this is a land use charge. This is not a tenement rate, but to the landlord is like a tenement rate sort of. Then there is stamp duties. All written documents relating to any property or interest in property which are transferred or leased to any person must be stamped. And so the stamp duties are paid at the rate of 75 kobo for every 200 naira. Okay, of the consideration of certain real estate transactions like mortgages, while for conveyance of the transfer or sale of real property, it's 75 kobo for every 50 naira. Okay, so we've talked about the real estate. Then we also have agriculture. Agricultural trade or business is defined in the Act as any trade or business connected with the establishment or management of plantation for the production of rubber, oil, palm, coffee, tea, and similar crops, the cultivation of or production of cereal crops, tubers, fruits of all kinds, cotton, beans, granola, nuts, the nice vegetables, pineapples, bananas and plantains, animal husbandry, that is to say piggery, poultry, cattle rearing, fish farming, deep sea trawling. All of these comes under the agriculture. So the gain of profit from any land used for agriculture purposes or for livestock shall, unless the relevant tax authority is satisfied to the contrary, be deemed to be gain or profit which should be realized by the taxpayer. If the lands were dealt with, as in the case may be, in a manner and up to average standard of cultivation, use or practice relating to the use of land. So what they are trying to say here is that when you make profit from the sale of this livestock or for the use of land, you are going to pay tax. So this is another area of special business. But what is of importance, main importance to the examination we are going to be writing is the taxation of foreign air and sea transport companies. This is where most times the questions come from. Foreign air and sea transport. Now, example of foreign air is British Air, British Airways. Sea transport, so any foreign air or foreign sea transport is regarded as foreign, as special business. So you will say that British Airways is a foreign business, but Nigerian Airways is not a special business because it's not foreign. Aero Contractor, I think it's Nigerian based, so it's not foreign. The taxation of the profit of specialized businesses are covered by the provisions of Section 14 to 17 of the Company Income Tax Act. Now, the specialized businesses covered by these provisions are, so look at them now, we have the foreign companies engaged in the air and sea transport business. You'll see that in Section 14. Then go to Section 15, you'll get to see companies engaged in cable undertakings. Okay, cable undertakings. This should be all these telecommunication companies and all that. Then companies engaged in insurance business, foreign companies now. So in the case of number B, foreign companies engaged in telecommunication, cable undertaking, so you won't put Nigerian companies who are into that, foreign company. Okay, then foreign companies that are into insurance business, both life and non-life. When we say non-life, we are looking at insuring your car, your house, and all that. Life insurance is another one. Then Nigerian companies engaged in insurance business. Then companies engaged in authorized units, trust, and scheme. So for your exam, you'll be thinking about those ones that are into air and sea transport and those in cable undertaking. You won't be talking about insurance business because this is a little bit above your level. It will be taken in a professional class. Foreign companies engaged in air or sea businesses are accessible to tax in Nigeria in respect of their income derived from the loading of passengers, mails, livestock into aircraft or a ship in Nigeria. So you see that when we say foreign companies, they are not registered in Nigeria, they are not incorporated in Nigeria, but they do business in Nigeria. So the business they do in Nigeria is that part that is going to be taxed. So how do we know the businesses of, let's say, an airline? An airline, how do we know the income generated from Nigeria? It means that the passengers must be loaded in Nigeria, in the aircraft in Nigeria. So the aircraft must be in Nigerian soil. Passengers will enter there, goods will enter there, mail will enter there, livestock will enter there. So origin of the transportation is what is required to know which business is that, not destination. So that means if British Airways load passengers from Nigeria to Britain, then it is a Nigerian income. But if they load passengers from Britain to Nigeria, it is not a Nigerian income. If they load a passenger from Britain and they had a brief stopover at Nigeria just to pass the night or so, or maybe technical problem, then later, maybe one day or two, they now continue the journey to the final destination. Maybe the final destination is United States. This is also not a Nigerian income. Now, incomes that are exempt from tax in Nigeria includes in respect of passengers, mails, and livestock. stock. This includes loaded on routes outside Nigeria, but terminating in Nigeria. I give an example, let's say from Britain or maybe any other part that is not Nigeria. That is where they load those things and they now end in Nigeria. Or in transit in Nigeria, that is brought into Nigeria for transshipment or connecting flights. I have just mentioned all that they had a brief stopover or maybe they changed transportation. You just take example like if you are traveling from Lagos to Abuja and you've loaded the car in Lagos and when you get to Benin, you have a flat tire or maybe the engine got knocked and another company from that same company, another vehicle from that company came from Benin to come and carry all the passengers to their destination. That second person that came from Benin is not going to get the income because this is just transshipment. So that is the kind of thing we are saying in relation to flights. So now how do we compute the accessible profits of a special business that is into airline or shipping? The determination of profit or loss derived by a foreign company in respect to loading of passengers, mails, livestock into aircraft or ship is done using two methods. The first method, which is method 1, which is the main method that you will be using in your exam, so pay close attention. Okay, I have sent the material for this class in the refreshers WhatsApp group. So do you well to go through the material, download it, and maybe perhaps follow through. Method 1. Method 1 is used when two things are done by the FROS. 1, they must be satisfied that the tax authority of the foreign company where the aircraft also is origin, the country of origin of this business, the FROS must be satisfied that 1, it computes and assess the airline or shipping company to tax in a basis that is not different materially from what we do in Nigeria. So that means the way they do their basis period is similar to what we do here. The way they charge their tax is similar to what we do here. The way they calculate their capital allowances is what they do here. The way they treat allowable expenses and disallowable expenses is the way we do here. They are satisfied and they say, wow, we are satisfied that you carry assessment to tax the same way, not too different from what we do in Nigeria. That is the first thing. Then secondly, the FROS had to certify the ratios that the company is using. Okay, so they satisfy as being applicable to the air and sea business 2 ratios that they must be satisfied with. The first one is what we call the adjusted profit ratio, and the second one is the depreciation ratio. What is the adjusted profit ratio? The adjusted profit ratio is like the adjusted income, the adjusted profits. This is your profit or loss before depreciation divided by your worldwide income multiplied by 100%. Now, look at this ratio. Let me give you an example. Let's say you have a gross income of 1 million naira, or let me say 100,000 naira. Let's say 100,000 naira. Then all your allowable expenses happens to be 40,000 naira. All your allowable expenses happens to be 40,000 naira. That means your adjusted profit is simply going to be 60,000 naira, right? Fine. Because 100 minus 40 will give you 60,000 naira. Now, if you want to know your ratio of profit over sales, you simply say your profit divided by your sales multiplied by 100. That is like your net profit ratio. Or just like saying, if you want to know your net profit ratio, you use profit over sales divided by 100. If you want to know your accessible profit ratio, so to speak, is your accessible profit divided by your income, your gross income times 100. So this one is called adjusted profit ratio because you have adjusted the profits to that area and now you are looking for the ratio. So the ratio is simply the adjusted profit, the profit before depreciation divided by your worldwide income multiplied by 100. That's your adjusted profit ratio. That is the first ratio they need to certify. The second one is your depreciation ratio. It simply means how many percent is your depreciation compared to your income. So your depreciation is your worldwide depreciation divided by your worldwide income times 100%. So all these ratios are given in percentage. They must be able to do two things. One, satisfy that the company is assessing the tax of the company's country assess tax, not materially different from how Nigeria assess their own tax. Secondly, that the adjusted profit ratio and depreciation ratio that they have calculated, FRS has certified it. In order to determine the accessible profits, capital allowances, and consequently the total profit chargeable to tax in Nigeria, the FRS applies the above ratios against the income derived by the foreign company in Nigeria. So what I mean is this. If you say that you have a gross income of 100,000 and your profit is like 60,000, that means 60% is your adjusted profit ratio, right? Fine. It means that worldwide, your profit ratio is 60%. Assuming Nigeria contributes 20,000 naira to that 100,000 naira income. If Nigerians' income is 20,000 naira, that means Nigeria's profit should be 60% of Nigeria's income. Because on a worldwide scale, the worldwide profit is 60% of worldwide income. So using that prorating, you will say that Nigeria income is 20,000. So Nigerian adjusted profit should be 60% of that 20,000. Then the same thing applies to depreciation. If the depreciation, let's say, is 10% of your total gross profit worldwide, you will still be applying that ratio to Nigeria income. So you see why they have to certify that ratio, because that ratio will be doing a lot in calculating the tax in Nigeria. So we can now look at the pro forma. The pro forma for that is this. One, we'll have to get income receivable in Nigeria, which we call the Nigeria income. So what we do is this: when you are doing special business, there will be a need for you to distinguish Nigeria income from every other income. So normally I usually say Nigerian income on the one hand, non-Nigerian income on the other hand. So when you add a Nigerian income and a non-Nigerian income, the total will give you worldwide income. So after getting your worldwide income, I want you to bring out, extract Nigerian income. So that is what this pro forma is saying. This is the Nigerian income extracted from the worldwide income. Now, you must have calculated your adjusted profit. So now you have to get your assessable profit is simply your Nigerian income multiplied by your adjusted profit ratio. Then that will be your assessable profit for Nigerian tax purpose. What will be your capital allowance? Is simply your Nigerian income multiplied by your depreciation ratio. That will give you your capital allowance chargeable in Nigeria. So when you less it from the assessable profit, you have your total profit, of which you will not pay income tax on it. So that's the pro forma. Now, when you are paying your income tax, you must always compare it with what we call the minimum tax. So the minimum tax for special business is not like the minimum tax for the normal non-special business. Normally, the minimum tax for other businesses, before it was reviewed by the new Finance Act, it used to be 0.5% of gross profits, or 0.5% of net assets, or 0.25% of paid up capital, or 0.25% of turnover. Okay? Then you look for the highest of all of these. Then if your turnover is more than 500,000, you look for 0.125% of the excess of the turnover of the excess of 500,000. Then you add it to that first one you choose, which one of them is the highest. That is what is your minimum tax for normal business. But the new Finance Act has changed that and simply saying that your minimum tax is just 0.5% of your revenue. And there is now a proposal in the new Finance Act that will be coming up. This is still a bill now, that your minimum tax should further be reduced by half. So it's going to be 0.25% of turnover. That is what the new minimum and the new finance bill is proposing. But in the case of special businesses, it has not changed. The minimum tax is just 2% of your Nigerian income. 2% of your Nigerian income. So your minimum tax with your CIT, whichever is higher, that is what you will use. Let's look at this question now. Question exercise SBO1. First one says, the profit and loss account of a foreign airline. So if you are reading and you see foreign airline and you see foreign, just underline and just know it's special business. And they say Ethiopian Airways Limited for year ended 31st March 2003 is as follows. I forgot to tell you that special businesses still do preceding year basis. They still do that. That's good. Okay. Now, I want you to look at this income here up to here. The sum is 120, 1.2 million. I want you to go to the chart room and identify how much is the Nigerian income and how much is the non-Nigerian income. You have 1 minute to do that. Please go to the chat room and see how you can take these exercises. Well, I've not seen anybody responding to this question. Perhaps I take it that nobody heard me as I was saying. Oh, somebody has responded. So you need to say, because it is, I asked two questions. Which one is Nigerian income? Which one is non-Nigerian? So when you put 400, I don't know which one is which. So we need to help me and show me which one is Nigerian income, which one is non-Nigerian. Still waiting for your answers. Okay, so non-Nigeria, somebody have given me Nigerian income. Miriam, give me the non-Nigerian income. Let's see. Okay, thank you, Miriam. Thank you for responding. Okay, so how do we know a Nigerian income? We look at origin. Income from passengers' flights into Nigeria. So where did they originate? Of course, when you see into Nigeria, it means they are alighting in Nigeria. It means they are not originating in Nigeria. So this 300 is not a Nigerian income. Income from goods loaded into aircraft in Nigeria. That means the aircraft is in Nigeria and they load them inside the aircraft there. It means this 220 is a Nigerian income. They now went on to say that income from passengers loaded and flown out of Nigeria. It means they were in Nigeria when they bought the plane and they flew out of Nigeria. This makes 180 to be in Nigerian income. Income from goods loaded into aircraft on other routes. Of course, it is a non-Nigerian income. So like Miriam said, 220 plus 180 gives you 400 Nigerian income. While 300 plus 500, which is 800, gives you a non-Nigerian income. Okay, now that is done, we now have less salaries and other expenses. These should be allowable because you need to pay salaries to your workers, other expenses. And if there is no note on these other expenses, since it was joined to salary, it is as good as allowed. Then depreciation. Of course, we know depreciation is not allowed. We need to do capital allowances. Okay? Then other disallowable expenses. Okay, that will mean that there will be a disallowable expenses. So of course, clearly, this 40,000 is a disallowable expense. So it will be added back. Okay, that will mean that there are other allowable expenses. This is other disallowable. That means this is not the only disallowable expense. There are some. So let's see if these other expenses, whether it will have some disallowable expense in it. Now, you were given the following additional information. Take note of point number 1. The FIRS is satisfied. That is a key word for you to know that you will use method number 1. FRS must be satisfied. Underline that the tax authority in Ethiopia computes and assess tax on similar basis with Nigeria. That's one thing that FRS will be satisfied about now and has received certification of the appropriate ratio. So they are satisfied. You've seen the certificate, they have satisfied that the appropriate ratios, which is the adjusted profit ratio and the depreciation ratio, they are nodding their head and say, yes, we accept it. That is what point number 1 is saying. Point number 2, the tax authority has agreed that depreciation charged in the account can be granted in lieu of capital allowance. It means that in absence of capital allowances, we can take our depreciation to become our capital allowance. Now, look at the point number 3. Salaries and other expenses include, of course, salary will be allowed, but it is the other expenses that is having issues. Deposit for a new VC-10 aircraft, 80,000 naira. This is not supposed to be an operational expense, it's a capital expense, so it's not allowed. Payment of 24,000 naira to the Nigerian Port Authority for the use of the VIP lounge at the new Murtala Mohammed by airline first class passengers disapproved. Payment of 12,000 naira as accommodation used as transit flat by the airline's crew disallowed. So if the income for the transit is not going to be an income to Nigeria, so this 12,000 is also not going to be an income, an allowable expense. Okay, now we are asked to compute the total profit for Nigerian tax purpose. Now, when we say total profit for Nigerian tax purpose, we are going to be looking at it, we are going to be breaking it down because this is foreign company. It means that we want to look at that Nigerian part of that foreign business. How do we get the Nigerian parts of this foreign business? That is what the A part is asking you to do. Then we are going to look at the income tax payable by the airline. Okay, so now let's go to the solution on page 7. Solution here on page 7. Let's go. All right. Now, the net profit that was given to us in the question. So this is it here. This net profit, which is 240. So I'm working from down to up. I'm working from the bottom to achieve my aim. I can always also work from the top to achieve my aim. So I'm going to show you how to achieve working from top to achieve your aim and how to work from bottom to achieve your aim. First, let's start with the bottom. We need the net profit for the year. That means this is 240,000 for the year. How did we get this 240? It is by, after getting our gross profit of 1,200,000, we started deducting all of these, isn't it? And everything we deducted there, we deducted both allowable and disallowable. All of them here makes up this 960, both allowable and disallowable. So it means that disallowable has been deducted to get this 240. But because they are disallowable, we are not supposed to have deducted them. So what do? Normally you use a journal. If you have deducted something that you are not supposed to deduct, what do? You add it back. So you add back your disallowable expense. So the first thing to add here in this 240 have the deposit for the new VC aircraft is there, is disallowed. Payment to Nigerian Port Authority is disallowed, and this transit is disallowed. That's accommodation for transit disallowed. All of them, you add them back so that it will increase your profits. So your profit was not supposed to be 240, your profit is supposed to be higher because of those disallowable expenses that was incurred, which you have decided to remove. So that means this is your global adjusted profit, which is 516,000. Now that is working from bottom down and bottom up. Let us work from top to bottom. First, we will have to get our 1,200,000, right? Now, if we have our gross income, we will now have to deduct, this time not add, you are deducting allowable expense. When you're starting from the bottom, which is net profit, and going towards to the adjusted profit, we add disallowable expenses. But when you are starting from the top, the gross profit, and you're going to accessible profit, you deduct allowable expense. This is because at this point you have not deducted anything. So what do? You deduct not everything in this 800,000. You have to remove those disallowable from it to find out how much is the allowable, and you remove it. That is the only thing you are going to deduct, because this is disallowable, you don't touch it. This is also disallowable, you don't touch it. So all you need to do is you find out how much is allowable. This is 80. 80 plus 24 is 104. 104 plus 12 is 126. So you deduct 126 from 800. That will give you the allowable. 800 minus 100 is 700, minus 26 is 674. So when you do that, and that's your allowable expense, you deduct it from this 1,200,000, you are getting 516 as your global adjusted profit. Now that you've done that, what next do you need to do? We need to get our adjusted ratio. For you to get our adjusted ratio, we need to do what? We need to get our Nigerian and our global income. Our global income we know is 1,200,000. So we've said Nigerian income is 400, non-Nigeria is 800, making 1,200,000. So what we will now do, your adjusted profit ratio is your global adjusted profit, which is this 516 divided by the 1,200,000, which is the global income, multiplied by 100 will give you 43%. So your profit is like 43% of your income. What does that tell you? On a global scale, profit is 43% of income. If that is so, on a Nigerian scale, profit of Nigeria should be 43% of Nigerian income. That is what the ratio is telling us. All right, depreciation ratio. In depreciation ratio, we are going to check the depreciation, that depreciation we disallowed, which is 12,000, 120,000 rather, divided by the global income of 1,200,000 gives you 10%. It means that your capital allowances is like 10% of your global income. So if we do that on the global scale, that same percentage should be applied on a Nigerian scale. Now that we've gotten the ratio is the link between the global income to Nigerian income. So that's why, since that is the link, FIRO has to be satisfied is okay. And how will they be satisfied? Is because they will have to check if you are computing tax the same way that Nigeria is computing tax. They will not be convinced of that, then they now certify the ratio, because that is a link to using it to do Nigerian tax. So now we come to Nigerian tax. We've calculated our Nigerian income courtesy of Miriam, and it gave us 400,000. So what do? We are going to use the ratio on Nigerian tax, on Nigerian income. We will now say your Nigerian adjusted profit is simply going to be 43%, which is the APRO, multiplied by Nigerian income. That gives you 172,000. That is like your adjusted or accessible profit. Then we go to capital allowance, which has been given in lieu of depreciation. Capital allowance is using the depreciation ratio 10% of Nigerian income. That gives you 40,000. So when you less this from that, 40 from 172, you have 132,000 as your total Nigerian profit. What was the question asking you? The question was asking you for total profits for Nigerian tax purpose, which is what you have just calculated. You have just calculated your total profits. Okay, now that one is done, let's look at the second one. The second question here is saying income tax payable by the airline for the assessable year 2004. So you see, it is preceding year basis, because these things were given as at March 2003. So they still do preceding year basis, just like every other. So how do we calculate the tax? Now, we'll bring out these points. This was our Nigerian income, isn't it? Yes. Now, this was our Nigerian profit, which we calculated using how we did our accessible, which is this Nigerian total profit, which is just calculated right now. So that's this. It is based on this that we'll be calculating tax. Okay, now it means that our income tax payable is 30% of this figure, 132,000, gives you 39,600. We are going to be comparing it with the minimum tax. Minimum tax is 2% of the Nigerian income. it gives you 8,000. So we are going to look which of them is bigger. Of course, the CIT is bigger, and so your Nigerian tax is 39,600. That is how it is solved. So summary, method 1 is only used when the FROS is satisfied that two conditions are met. The company's country of origin is assessing the company to tax in a similar way that Nigeria does it without material difference. And secondly, the ratios, the APR, adjusted profit ratio, and the DRO, the depreciation ratio, are being certified. Method 2. This method is only used when the FIRS, Federal Inland Revenue Service, is not satisfied as to the conditions we mentioned in method 1. And so if they are not satisfied that your company is using a similar tax system that we are using, or if they are not satisfied about the ratio, then that means the two conditions did not meet FIRS expectation. And so they will tell you, we are using method 2. FROS is given the discretionary power to determine the profits derived from Nigeria by applying what they call fair percentage. Fair percentage on the sum receivable in respect of passengers, livestock, and goods shipped or loaded into Nigeria. What are they saying to you now? It means that they are not satisfied in your account, your APR ratio. They are not satisfied. They are not satisfied. They cannot certify the ratios. Or perhaps they are not satisfied about the method you use. But all they know is that you can distinguish Nigerian income from worldwide income, from other non-Nigerian income. That would mean that they will go and check, give us Nigerian income. All those things you loaded inside Nigeria, so aircraft in Nigeria, so you can easily get that figure. That is just what we want. Now, when we get that, FROS will now say, let's use a particular percentage, a fair percentage. Let's say we use this percentage. So FROS has that discretionary power. It could be higher than your APR, it could be lower than your APR. That is left for the discretion of the FIRS. So they use a fair percentage to multiply your income in Nigeria to get your assessable profits. And so from there, they will charge you to tax. Points to note under method 2. In points to note there, the company, irrespective of the fact that IFRS has done method 2, they can ask them to recompute it based on method 1. And that will only be valid if the company made that request within 6 years after the end of that relevant year of assessment. Otherwise, it is not valid. Okay? So, most times, whether they do method 1 and whether they do method 2, method 1 will have to be recomputed. So method 2 is not the issue here with us. The issue is the method 1. It is always going to be done in exam, whether they give you method 2 or they give you method 1. So what they do is they will tell you the FRS is not satisfied, and they will also give you a fair percentage on what to use. Follow along with the question and use whatever they ask to use. Then the taxpayer will say, all right, you've done your own, right? do it using method one. And so whichever is better for the taxpayer, that is what we'll be taking. All right, so we've done taxation of airlines and shipping. Let's go into taxation of foreign companies engaged in cable undertakings. Cable undertakings. Where a foreign company is engaged in the business of transmission of messages by cable or any other form of wireless apparatus, it is accessible to tax in the same way as a foreign company engaged in air or sea transport. So it means that people like MTN Nigeria, who are also using telecommunication, they belong to these foreign companies engaged in cable undertaking. Glow Nigeria does not belong because it is not a foreign company. Okay, so all these foreign companies, they are under that situation. So we see here that that method one or method two that we use in the cable or sea business is what we are going to be using in telecommunication. Secondly, we are going to be looking at where do you derive the income. So it means that if you make a call, if you buy a recharge card and make a call in Nigeria to UK, the call is a Nigerian income. If you buy the card in Nigeria and you now travel to make the call from UK, the card purchase is a Nigerian income. Since it is a prepayment, it is a Nigerian income. That's why you see people doing roaming. And when they roam, it's as though you are still in Nigeria, and so it is Nigerian income. Except you buy it from the people there over that is not in Nigeria, you didn't buy the card from Nigeria and load it in Nigeria, then it is not Nigerian income. So we need to look at where the message is originating. Okay, so let's look at exercise 2 and let's see what we can get here. Ultimate Limited is a Canadian foreign company. These are keywords. Canadian, that has tell you it is foreign business, foreign company, then you are suspecting, then you now see engage in cable undertaking. That hits the head at the nail. Special business in Nigeria. Its worldwide management account for the year ended 30th September 2002, you know it is 2003 year assessment year. Okay, look at what it reveals. So I want you to look at all of these now. Go to the chat room and tell me how much is Nigerian income. I'll give you 1 minute to do that. Nigerian income, how much is it? It appears nobody is listening to me, so I will just go. Income from cable messages terminating in Nigeria. This is not originating in Nigeria, it is ending in Nigeria, so 200,000 is not a Nigerian income. Income from cable messages routed through Nigeria, this is just transit, it's not a Nigerian income. So income from cable message originating in Nigeria, that is a Nigerian income. So 100,000 is your Nigerian income. Okay, so we have all these. Depreciation is not allowed, salary and wages are allowed, overhead expenses, we will know if it is not allowed or not. Then we have purchase of equipment, definitely not allowed. Then let's look at it. Notes, the FRS or Federal Inland Revenue is satisfied, that's a key word, satisfied that the tax is computed and assessed in Canada, the country of the foreign company, on the same basis as Nigeria. That's one satisfaction. Canadian Tax Authority has certified the adjusted ratio and depreciation allowance ratio. That is another satisfaction. Included in overhead expenses, these overhead expenses are disallowable item totaling 23 million. So out of this 85 million, we have 23 million that are not allowed. So we are told here, compute the company's adjusted profit. How do we compute the adjusted profit? So we go here to adjust the profit. So what do we do here? I use the first method, which is working down. We start with the net profit, 56,000. We are going to add, just hold on a moment. Okay, so let's come back. All right. One, we start with the net profit, 56,000. Then we add back all the disallowables. The first one is depreciation. Then that 23 million of overhead that was disallowed, we add it back. Then the purchase of equipment, we add it back. So these three add back, added to give you 152, which we will add to 56 to give you 208. That is one way of getting your global adjusted profit, 208. Another way of getting your global adjusted profit is to work from top to bottom. We have 450 as our global income. We will remove allowable expense. One of them is this 180. So 450 minus 180, we remove that. Then the next one is after removing 23 million from 85 million, the remainder is allowable, which we will remove from here. Everything will give you 208,000 when you work that way down. So that is your global adjusted profit. Then what is your global income? It is this 450 which was given to us in the question. So how do we get our global adjusted profit? It is just this way. This 208 is our global adjusted profit. The next question says, determine the adjusted profit ratio and the depreciation. So can you see the process? First, you will need to know the company's adjusted profit, worldwide adjusted profit. Then the next thing to do is to know your adjusted profit ratio, then your depreciation ratio. These are the two things you need to know. After knowing those two, then you apply them in the Nigerian context. So now let's look at those two. We look at the adjusted profits for Nigeria for 2013 year of assessment. So we need to done that adjusted profit. We are now looking at the determination of adjusted profit ratio. The adjusted profit was 208. Your global income was 450. You multiply by 100, it gives you 46.22%. And when you do the same thing for depreciation ratio, you have your global depreciation, 90,000 divided by 450. I think it's going to give you 5% or so, or 20%, sorry, gives you 20%. Okay, so that's the second one. The third one says computes the tax total profit and income payable in Nigeria. So your total profit is, you have your total profit, you have your Nigerian income as 100,000. You now have your adjusted profits, Nigerian adjusted profit, you have 46.22% multiplied by 100,000, give you 46,200. Then you less your capital allowance of 20%, gives you 20,000. Okay, when you less it, everything gives you 26,220. That is your Nigerian total profit. What about the tax payable? The tax payable is simply your Nigerian income is given to us here, 30% of 26. Nigerian taxable income, 30% of your total profit gives you 7,866. Then your minimum tax is 2% of 100,000, which gives you 2,000. You look at them, which of them is bigger? Of course, the higher is this 7,866. So that is how we calculate the method one of special business. Of course, if the FRS is not satisfied, they can decide to use method two, and the company will require them to also use method one. So far, so good. We've learned about foreign businesses that are special. We said we have airlines and shipping. We also have cable undertaking. We now saw that in CETA, section 14 to 16 tells us what to do when we see a foreign company that is under the special business regime. One, they still use the preceding year basis. Two, they are still charged at 30%. Three, they are also having minimum tax. The minimum tax is 2% of the assessable profits. Also, what we do is we look at it in steps. First, we look for the worldwide income, which we will separate between Nigerian income and non-Nigerian income, makes up the worldwide income. After getting your worldwide income, you now go to your worldwide profit. How will you get your worldwide profit? All you need to do is to apply your accounting or your taxation principle. Remove all the allowable expense, or if you're working from net profit, you add back disallowable. So you get your adjusted profit. When you get your adjusted profit, you now look for the ratio of adjusted profit to the global income. That will give you adjusted profit ratio. Then you also look for the ratio of depreciation to your global income. That will give you a depreciation ratio. So if this ratio is certified, then that is what you'll be using as a link to link it to Nigerian income. That means you are going to say, bring your Nigerian income multiplied by the APRO to get your adjusted profit for Nigerian tax purposes. You also bring your Nigerian income multiplied by the depreciation ratio to get your depreciation or capital allowance for use for Nigeria. You less your capital allowance from your assessable profit, you get your taxable profit, of which you look for 30% of it, compare it to minimum tax of 2% of Nigerian profits. So far, so good. That's your analysis for special businesses. Okay, so this is the topic for today. Feel free to ask any question. On Saturday, we'll likely have our last class for this diet. I'm going to also give you some tips, possibly some tips on how to answer questions in taxation. So come prepared, come in anticipation of that class, and feel free to, ask your questions as needed. Thank you so much. We'll be ending the class today. For now, look forward to seeing you in our next class. Thank you so much, and do have a nice day.